Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by my good friend, Manmit Pandori, head of tactical and accrual trading at BMO. This week's episode is titled, A Brave New World. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Manmit, welcome to the show. Happy to have you on for the first time, and interesting time to have you on.
Thanks, Ben. Yeah, I think it's definitely a brave new world, I guess, like you said.
I'm not sure brave's the right word, but I couldn't think of a better one, so let's stick with that for now. It's Thursday morning, so usually I record on Wednesday, but for obvious reasons, Trump, tariffs, obvious. We push this to Thursday morning to try and get this thing to be a little more timely than it usually is. So it's challenging to know exactly where to start here, but I guess Manmit does a lot of investing in various rate products across the board and other stuff as well. And he is very well known on Bay Street and very well liked in BMO and outside of that. So I thought it would be beneficial to bring him on to give us a investor's point of view from effectively a bank treasury. So
Sure.
This is why he's here. So how do you view this evolving? We can start with assets, or you can start with Trump. Either way, like, is he going to back off? Two, what are you doing today? What are you looking at? How have you been positioned coming into this? And what do you do now?
Yeah, I think so. Maybe a couple of things. I think one, in terms of how we were kind of shaping the world coming into this was, I think it was the first time over the last 2 years, I would say, that, it finally felt as though having gunpowder and having capacity to kind of take on risk was really worth it, and was worth a lot. I think over the past 2-3 years, sitting in just kind of like idle capacity as far as risk goes, it was a losing proposition. You were kind of giving up carry, sitting and just like having that extra gunpowder wasn't really worth a lot, because, spreads just kind of were grinding tighter in most like credit assets. And so, you were always wanted to be pretty much fully invested. I think, coming into this, and not picking out yesterday specifically, because I don't think anyone anticipated the type of move we're seeing this morning, especially. But we were kind of over the course of, I think, January, February, just kind of saying like, spreads are really tight. And we kind of took some chips off the table. And it was the first time, I think, over the last number of years where having capacity and just kind of getting our, size of our amount that we're invested lower was really kind of a goal of ours. I would say, like, coming into this, we were probably, let's say, early in January, let's say 80% invested, if I think about like our risk capacity. And then over the last like month or two, we kind of put that down to like 50. And so, coming into this, we were at like 55, 58% kind of invested, if I think about like our stress capacity. But that wasn't, not to say that we were brilliant and we just knew exactly what he was going to do.
You knew something, clearly.
But I think it was like the skew of what was priced in was just... And, there was an article in the Wall Street Journal this morning of just like, there was a lot of complacency, I think, priced into the markets. And so I think everyone kind of expected a little bit more of a game of chicken with him, where he would kind of fold to the market. And so it'll be interesting. You just mentioned Trump, is like seeing how he reacts to this market move. He says he doesn't care about stocks.
We'll see. He doesn't care until he does care. When they fall enough, he's going to care. And that'll be a different story.
I'm curious to hear what you think.
Well, so pretty much every single investor I've spoken to for the better part of a month, the refrain has been low conviction.
Yeah.
Like totally. Extremely low conviction, and trying to stay as close to home as possible. So if you're a big real money investor, that's kind of just staying as close to the index as you can stay generally, and not really taking on any meaningful curve or duration positions or credit positions. That doesn't mean they were selling though, and that's the difference. So I think that's where like you have an advantage there. You can sell. You can be like, all right, I don't want to own stuff. I don't have to.
Sure.
They have to own stuff.
Yeah.
So that it makes it more challenging for them. And I mean, that's really hard. But that makes sense that you were able to pare back. I mean, that's good foresight there. And I think the complacency wasn't complacency. I think it was an inability to really make a decision because you don't want to buy, you don't want to sell. And so as money comes in the door from RSP contributions and 401k contributions, people just keep buying. And even if it's not big amounts, it just that flow continues. And that's why stocks, I think, hung in there as well.
For sure.
Because no one was willing to be like, you know what? I want to bet against risk because risk has done so terribly over the past few years. Hold on, stocks only go higher until today. And I think the unwillingness to do that has been why it seemed to be complacent. I'm not sure that it is. I mean, maybe I could be wrong there, but we'll see. And then we'll see if Trump walks us back. And that's really the question, I think, at the end of the day. There's no point in even answering that question, but we'll see how things go. The bright side is that Canada gets off, dare I say, relatively lightly. I'm not even I mean, that's not really right. I mean, we're still getting hit here. We're no worse off than we were 2 days ago. That's pretty much the way that I look at it. And if anything, it's now you need to step back and look at things through a global lens.
For sure.
And so one of the big moves today is the broader weakness in the US dollar, the rally across the curve in treasuries, and what this tariff move means for US dollar assets. And so I listened to a really good podcast. I mean, part of it was really good a few weeks ago. And one of the themes was capital renationalization. If countries are selling fewer products into the US, which is what will happen, they also have fewer US dollars. They also have fewer dollars to recycle into the treasury market or other US assets, being stocks. And so that capital stays home. And then what happens? So we're seeing treasuries rally today, but how do you think that dynamic with falling global trade flows evolves from a treasury market perspective? Or just broader US assets, if you'd like.
Look, like, a lot of this stuff just got announced yesterday, and as Benny said, we're recording this Thursday morning. And so I think, over the coming days, maybe we'll get some clarity, maybe we won't, on how this stuff is going to evolve, how other countries are going to kind of hit back. And already you're hearing of France, Germany, these guys coming out saying they're going to be a little bit more aggressive on I think the biggest kind of factor in all of this, in my view, is really what happens with China. There's the amount of tariffs that they're trying to put on to China is astronomical.
This is insane.
It's a lot. It's big numbers, and China's largest foreign holder of treasuries. I don't know how that all plays out, but I think to your point of where the incremental dollar was always really being invested in the US. I think about even our portfolio, 90% of it or 95% of it shifted to US dollar assets. Obviously given swap spreads and other things like that. But I think some of that starts to change probably over time where, you're looking for more opportunities domestically in your home currency. And so, some of the asset classes that tend to have a large amount of foreign buying, like U.S. mortgages, U.S. treasuries, these things, what happens? And there's still a ginormous amount of fiscal deficit that, the U.S. needs to finance. And so, I think this morning you're seeing a bid for treasuries more just as a kind of risk off type of move. And I think a lot of these moves nowadays are exacerbated by the fact that conviction is so low. So you're not seeing real money guys or larger asset managers kind of step in and defend some of these moves. In the past, you look at US swap spreads this morning, even it's you would see just real money guys coming in and defend. So I think that because the conviction is so low, it's more driven by hedge funds, more driven by just faster players in each of these markets. And so I think that's just causing all these moves to be a lot more violent than they've been in the past. And so I think maybe to your question around US dollar assets, I think we have to kind of see how this plays out. But I don't see all of a sudden conviction going back the other way of, oh yeah, a team like my team or other investors are saying all of a sudden, okay, I know what's going to happen. I'm going to be able to kind of price in one path because there's so many offshoots of what could happen. So maybe I'm not really answering your question. It's like, I just don't know.
I mean, that is a very fair. I don't know either. That's the problem with all this. We don't know what's coming next. We don't know if Trump changes things. The number on China is huge.
Yes.
And the number on Vietnam is big, and you have really big tariffs, and I'm going a bit more macro here now. Really big tariffs on exporters of low value added goods into the US.
Yeah.
And so this morning, a client messaged me, and I mean, he probably messaged a bunch of people. It's a spam message, but he said, "I'd like to personally congratulate America on all the $2 per hour factory jobs that will be coming over from Vietnam." And I mean, that's right. I mean, part of the benefit of global trade is that you can make higher value added goods and services and offshore some of the stuff that you're, quite frankly, too skilled to be making.
Yeah.
And what these tariffs do is they unwind that. Yeah. And so you're going to have to bring back, I don't know, sock makers to the U.S. And the price of the socks is going to go from whatever they were, 50 cents or a dollar, to $4 or $5, $6. And I can't get away from this being a hugely inflationary event. Those tariffs, they're such big numbers. I don't see how consumers are not absolutely floored by the price increases that are coming. And I would guess they're coming very quickly.
Yeah. And I think also just on that point as well is, it'll be very interesting to see how central banks respond to these various tariffs and what they'll mean for the economy. Because to your point, like, Trump thinks that, he's going to rejig the whole manufacturing kind of industry in the U.S. To be honest, I just can't see that happening.
Oh, there's no way that's happening.
Yeah,
just
to
be clear,
we're not going back to the U.S. building, factories to be creating like plush toys or things like this that like China makes for nothing. And so maybe that could happen in theory, but that's like a 20 to 25 year kind of like thing that's changed over the course of in the U.S. And so I just think that his thought how impactful this is going to be on some of those things is like just not really going to come to fruition. And then like I don't know how the central banks respond. Like I guess you assume we just don't see any cuts, but then if you get, because of inflation, to your point about these various things, but then on the flip side of that is like, if you go into like a pretty deep recession here or something like that, then how do the central banks respond to this? I think it's a very, very challenging time for those central banks. And I think because of that, maybe back to what we were saying at the beginning, this is just that conviction stays low and people, just end up in places in their portfolios that are like, I'm going to stay in high quality stuff and liquid stuff and just try to wait this out. I think is, the most likely response you'll see from a lot of guys.
Does the U.S. take the worst of this at the end of the day? In that, like, I'm just trying to work through this in my head as you're talking. I was like, oh, here's an idea. Canada has fiscal capacity. Europe has some fiscal capacity thanks to Germany. So Germany has fiscal capacity that will get effectively transferred throughout Europe. Japan, they probably do still have some where they are. The U.S. doesn't really at this point. And so you have an environment where there's relatively high inflation. You have central banks, or relatively higher inflation, definitely higher than target. You have central banks that are probably unwilling to ease in the near future. I agree that there's going to be a much weaker economy at some point in the next kind of 3 to 6 months, and that will show up in the numbers very clearly. But the question then is like, well, how do you balance inflation and growth? If the inflation is still kind of entrained and still flowing through the system, do you really want to be easing at that point and risk secondary rounds of inflation? And the answer is probably no. And so you have central banks that won't cut or will not cut aggressively, that's for sure. And in the U.S., you have a government that really can't spend more without potentially causing some kind of fiscal issue and market malfunction potentially. The U.S. then maybe takes the worst of this, because I do expect we're going to get something big fiscally in Canada. No matter who wins, we're spending more. I can virtually guarantee you that. And Germany's spending a ton more. And we'll probably see the same from a number of other countries, be my guess. And so amazing how this can backfire so spectacularly on the U.S.
Yeah, and I think his thought is that around like, changing these tariffs, the deficit in the U.S., they're funding, some of this deficit through these tariffs. I think it's not a very well thought out
backwards, illogical. I mean, you want to say stupid, I'm okay with that.
Okay,
I usually don't do that, but in this case, the level of tariffs just and the way that they've been calculated,
yes,
is mind-boggling.
and that's the challenging part. Like, even yesterday he comes out and says that they're so focused on doing reciprocal tariffs. Like, I think how you sell this to the American people too is like, you could say, sure, like, this country charges us X on this product, so we're going to charge them X on this product. But that's not even what they're doing. They're just basically creating tariffs to try to minimize the trade deficit with some country. That's a totally different thing than actual reciprocal tariffs. It's not really. And so I think, this could, and this is where, like, again, it's really difficult to predict what he's going to do because he's a, very unpredictable person. But this is where I could see them walking some of this back, of just how you sell this to the U.S. people. And it's obviously, midterms are still quite a bit away, but I think that on that front, is a common person in the U.S. gonna like look at this favorably? I don't think so.
No,
it's just not gonna work. And like, his point of view might be that, okay, by closing some of these trade deficits, we're going to be able to fund the fiscal deficit better. Like, I just think it's very illogical.
Correct.
Yeah.
A lot of it makes exactly no sense.
Yeah.
The way that they calculated the tariff and other barriers that other countries have on them is complete and total nonsense.
Yes.
And quite frankly, just reeks of them not really putting in the work that needs to be done to do this kind of thing.
Which I think, we all kind of, so much of this is kind of done haphazardly. Like, you were hearing about stuff like they hadn't even had this finalized until maybe yesterday morning.
Well, that makes me kind of afraid. So I had previously thought that there was a larger plan at work.
Sure.
But when the things are coming kind of haphazardly, as you say, and when people within the administration don't know what the end goal is and what the path forward is, the day before something as big is happening, tells me there probably isn't a bigger plan, and that is concerning for me. But no more disparaging on the U.S.
Sure.
I'm curious what happens with the rest of the world. So I was discussing this with Naveen, and we can continue. Naveen's our inflation trader, and Naveen keeps asking me, when is Canada going to match the U.S. tariffs, or how are we going to, on what sectors? How long will it take? Will there end up being a customs union at the end of the day? So he asks me this 5 times a day. Since I'm the Canada guy, he likes to ask me, and my answer is usually I don't know. But where I get to when he asked me that question is, okay, well, I take a step back globally. If you were exporting a ton of goods into the U.S. and now the price of those goods has gone up by anywhere from 10 to 40% or more, you're going to look for alternative markets. And the alternative markets where there are people that buy stuff, because you need to find rich countries, and that's what the U.S. is. So you're looking at Europe, you're looking at Canada, you're looking at Australia, and Japan, I guess. But Japan's got a decent amount of trade barriers as it is. And one thing, in fairness to Trump, a little bit on that front. And so are we going to see a flood of goods come into Canada, Europe, Australia from everywhere? And is that going to force those countries to put tariffs on the huge surplus countries like Vietnam and China, et cetera? And then we kind of spiral down this terrible path.
Yeah, I think it's a good question. I think in general, when you look at thinking about game theory or these other kind of things, it's like, this is the worst thing that you could do, which is you start going down a path of tit for tat kind of thing, and I'm going to respond to it. And so you can very quickly spiral into just a walking back all of what globalization has done over the last 50 years or whatever you want to call it. And so I think that it's a very dangerous game to do that. In Canada specifically, it'd be interesting to see what happens. I think over time, you're definitely going to see most of these countries try to pivot away from the US. I think, Canada especially has gotten more and more entrenched with just relying on the US for basically everything. And not to say that that's going away. They obviously, spared Canada and Mexico to some degree, I guess, in the announcements yesterday. But yeah, I think, you see a lot of these countries probably want to pivot to how do I sell more goods into the EU, into these other countries? And so I think that definitely happens. As far as reciprocal tariffs go from each of these countries, it'll be interesting to see how each of them respond and how Trump responds to that.
Yeah.
I think if you see the EU, Germany, France come out and be pretty harsh on the US as a response, does then Trump like double down on, hey, I'm going to put on even harsher tariffs because they're coming after us? Like, it can be a death spiral very fast. The one thing again, like maybe bring it back to markets is like, I just don't see how he's, just eroding financial conditions and basically kind of destroying the market to some degree, how long they can bear that. Bessent was on a Bloomberg interview this morning. I think he's at a loss himself too of how to really respond. And so as far as, assets and, how we will think about the portfolio in the near term is probably continuing to just have on keeping that capacity light and focusing on how we're hedged, how we're managing our hedges, and just waiting this out, I think, is the only response you can really have, because it's not as though anything is more clear than it was a day ago, I feel.
What signal are you looking for to get more involved? So like, how wide do spreads have to go? I don't know if there's a number there, quite frankly, and that's an unfair question for me, given that can mean anything for anyone of a number of products. But is there like a marker that will say like, okay, I'm more comfortable now, or assets are cheap enough now? Do we need to get to historical cheap levels? Is it COVID cheaps? Is it financial crisis cheaps? Is it, I don't know. Or are you waiting for like a macro event where Trump's like, okay, stocks are down, I don't know, pick a number, percent, and I'm no longer comfortable where things are going. It's time to back off. And then you're like, okay, well, let's go. They're going the other way here. So is it market driven or macro driven, or maybe it's a combination?
I think for us, in terms of how I think about the portfolio, we're definitely we'll be focused on the market side. I think about like a couple of, key signals that we would focus on in this environment is kind of like break even carry in a month. We look at that very closely of just, how much widening can you bear to really offset the kind of carry you're making. And so, because it's really hard to say like, when is this going to turn around, or what stops this from going in that direction, especially if you get just back and forth, each country hitting with each, like, you have no idea, how much that can really just go. And so I think we think about stuff of saying, okay, if you buy swap spreads in the US, or you buy, US assets, or even in Canada, or things like this, like how much are you getting paid to sit in that risk is a key kind of number that we would look at. And as long as that hits our bogeys on certain things, I think that's when you can start to dip your toe in, because you're like, hey, look, if I'm getting paid 5 basis points of break even carry in a month, and I need this thing to widen 5 beeps, and that's a decent amount, depending on the asset class, obviously, is that enough for me to sit in it? Maybe. Yes.
Are we close to that point? Are we?
No.
Like how? That was a disappointed head shake. No. So, I mean, there's probably meaningful downside here before investors like yourself, who I would say on the margin, when spreads get wide enough, you're the type of guy that steps in. Your team is who steps in. And like, those are the types of balance sheets that will end up supporting the market, but we're not close to that point.
Yeah, I think we're just not close to that point. Plus, also, I think, because it's so difficult if management comes to you and is like, why did you get long here? You don't really have a reason right now.
Yes.
Right. And so how do you defend that decision, I think, is challenging to say. Now, if you start to hit some bogeys on some of these break evens that I'm mentioning, or other things like that you could kind of defend the position to say, okay, like, this is why I got into here, or, something you think is going to turn around, it's just really difficult to defend why you're getting long here. I just think that there's skews probably more in your favor of like, we're going to continue to see some downside. And then, one other thing I'll just say is like, for us especially, is it feels like it's one of those markets that, we're okay missing the first few basis points turnaround, right? Like I think being first, obviously we aim to be, and we want to, that's, we try to maximize how much money we're making and everything. But being first in this market is a very scary proposition. So maybe you leave that to the Bridgewaters of the world, or whoever's going to make those calls. But from our side, I'd rather see a little bit of performance and a little bit of stability come back, and then miss a little bit. Yep. And then, and then start to get involved. And so I think that's one of those ones where it's like, it's very difficult, like catching a falling knife kind of thing. Exactly. And that's just not our game at this point, because it's really difficult to see this turning around absent him walking it back and just saying, okay, we're going to do. But, I think that there's a lot of politics involved in that. There's a lot of ego, for lack of a better word, involved in that and those things. And so I think for us, we're just not at a place today where we would say, okay, this is all the pain we're going to feel, and let's start stepping in. But I think looking at some of these metrics like break evens and some of these things are the only way to kind of shape what you're buying at this point. And then starting to see a little bit of performance the other way is really, and don't get me wrong, like it's a long only book, more or less, right? So we're long, like it's just whether we're long or less long. Exactly. Okay. Exactly. Okay. And so, yeah, that's, I guess, maybe the way I think about it.
I mean, that's great. Manmit, thanks for coming on the show.
Thanks, Ben. Thanks for having me.
Hopefully we get a little bit of clarity over the next, pick a number of days. Anything you want. Any little crumb of clarity will be helpful. I don't think we're going to get it, but at least the market will be a little more interesting, I guess, now after waiting all this time for April 2nd. So
for sure.
Good luck to you and good luck out there.
Thank you.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.